The mainstream media seems to be fixated on Bitcoin, and this is obviously for good reason. But it seems that Ethereum is not getting the same amount of coverage. Now here's a fun fact. Last year, ETH outperformed BTC by over 44%. Oh, and by the way, while Bitcoin is already 60% above its 2017 all-time high, ETH is still over 30% below its. So this begs a very important question. Is ETH ready to rally? And if so, how high can it go? Well, that's exactly what I'll be covering today. In this video, I'll be taking you through some of the most important recent Ethereum updates and what they mean for the network. Oh, and I may have a sneaky ETH price prediction for you folks too. So be sure to stick around till the end. Before I get cracking, you and I need to have a quick heart-to-heart. Now, I know this may come as a shock to you, but I really must admit, I am not a financial advisor. So yes, that means that everything in this video should be considered as educational. Only you can DYOR. Now with that icebreaker out of the way, allow me to introduce myself. The name is Guy, and I am the head honcho here at the Bureau. Some call me the Crypto Guy. This is because it's my sole mission to bring you the latest and greatest from the crypto space. News, reviews, guides, and overviews. So, if that is up your alley, then be sure to subscribe to get those daily. Don't leave that bell hanging either. Ping that little guy, and the YouTube overlords will ping you whenever I release another video. Right, that's enough pitter-patter. Let's get on to what matters. In order for us to understand the potential of ETH in this bull cycle, we have to take a look at how it performed in the last bull cycle and what the driving factors were back then. It could help us inform whether this time is different. Let's hop into our crypto time machine, to a time when Corona was a beer and social distancing was something you only did with no coiners. It's late 2017 and the crypto bull run is in full force. Bitcoin is continually breaking its all-time highs, and the CME just launched their Bitcoin futures. The retail frenzy is at unprecedented levels. Everyone is out there looking for the next Bitcoin, and Ether seems to be the most likely candidate. Just take a look at this graph of Google search trends back in 2017. As you can see, people were Googling the hell out of Ethereum. You can actually map these Google search trends with the rally in the price of ETH in early 2018. Of course, there was something else going on during this time that was also driving the price. For those who can remember all the way back to late 2017 and early 2018, you'll no doubt remember the crazy initial coin offering days. Teams with nothing more than a white paper and landing page were raising millions of dollars for their projects. Heck, some of these ran into the hundreds of millions, something unheard of in the startup fundraising space. Now, what does this have to do with ETH, you may ask? Well, over 90% of these projects were issuing their tokens on the Ethereum blockchain. And in order to do the raise, people had to send them crypto in ETH. This therefore meant that you had a massive rise in the demand to use ETH in order to contribute to these ICOs. If we were to overlay this with the demand that people had just to hold ETH, then you can see why things went parabolic. We reached an all-time high for ETH of over $1,400 on the 13th of January. Pretty crazy. Now, there's only one issue with this, though. This demand is fleeting. Newbies investing in shitcoin ICOs in the hope of making 100 times are not the most rational of investors. Moreover, you have to consider the supply side of that equation. Those receiving these ICO funds were the project teams themselves. Now, while some of these project teams had good intentions, the vast majority of them were in it for a money grab. Either they just sold their crypto and exit scammed, or they built a vaporware project and exit scammed over time. Even those projects that did build solid technology still had to sell some of the ETH that they raised. They had to lock in the fiat value and fund development. This means that you had a situation where ICO funds were circulating back into supply and dumped on some of those retail investors. So this supply was certainly not sticky. It was not being held by steady hands with a long-term vision about the prospects for Ethereum. Of course, the moment that the market started to turn in late January, these ICO teams started dumping their tokens. Add to that the fact that retail investors were not jumping into the ICO markets as eagerly as they were in the past. So, you have a flood of supply with a much reduced demand. The result was, of course, a collapse in the price of ETH, all the way down to a low of about $91 at the end of the year. Not ideal if you're one of the few that bought near the top. Of course, with ETH now touching above 1K again, it begs an important question. Could something similar happen? Highly unlikely, and this is for a number of reasons. Let's start with the most fundamental of those first. Who is buying? Now, while 2017 was a mostly retail-driven rally, it appears that this time, those who are buying are deep-pocketed institutions and whales. As I pointed out last year in my video on Bitcoin institutional adoption, these traditional money men are looking to capitalize on other crypto assets. Now that they fully understand the value proposition of Bitcoin, they have gone down the rabbit hole of Ethereum and are loving what they're finding. There are a number of data points that I can point to, but let's start off with one of the most well-known, the amount of ETH held by Grayscale. Most of you will no doubt know that Grayscale is a large asset management trust company that issues crypto-backed shares to institutional investors. Over the past year, they have seen an explosion in the amount of ETH that has been demanded by their investors. This has, of course, meant that they had to accumulate more ETH from the market to keep in their funds. For example, back in May of this year, there was about $210 million in ETH in the Grayscale funds. They had issued just over 13.5 million Grayscale ETH shares. How do those numbers look today? Well, there is over $3 billion in ETH and over 285 million shares. Clearly, those guys buying shares in Grayscale have been lapping it up. We can even hear it from the horse's mouth. Here is the managing director at Grayscale Investments in a Bloomberg interview. He states that, quote, "There's a growing conviction around Ethereum as an asset class." What's even more interesting than just this is the fact that he sees these as a new kind of investor that is, quote, Ethereum first. So not only are these investors lapping up Ethereum, but they are mostly focused on Ether. Okay, that's just Grayscale, which issues shares in its fund. What about those buying off the market and stacking? Well, we can take a look at some on-chain data to get an indication of that. Over here, we have a chart from the folks over at Sentiment. It basically takes a look at the wallet action of the whales, those with more than 10k ETH. It shows that in the last few weeks of December, the number of whale wallets had been increasing, whereas the number of wallets with less than 10,000 ETH had been decreasing. Now, this can only mean one thing. The whales have been accumulating at the expense of the smaller investors out there. So, if you've sold out all your ETH in the past month, a whale somewhere is smiling. And it's also important to point out that in the case of both these wallets and the ETH held by Grayscale, the investor profile is considerably different than it was in 2017. Back then, the whale wallets were in the hands of skittish ITO teams, and those trying to accumulate were fickle retail investors, both of which had pretty weak hands, neither of which really appreciated the vast potential of ETH. So, this institutional accumulation through 2020 was great. However, I happen to think that this is only the tip of the iceberg when it comes to institutional adoption in 2021. And that is because something pretty exciting is going to be launching in February. I am, of course, talking about Ether futures. No, not that one. Yeah, the CME kind. On the 8th of February, the CME will be listing Ether futures instruments. This follows over 3 years since they launched their first Bitcoin futures. Now, although ETH futures have been trading on a number of exchanges long before this, the CME futures instruments are something quite different. This is because most of the market participants that are trading in these types of listed instruments are institutions with broker accounts at the CME, not your average leveraged trading newbie. The reason why I think that this could signal further institutional adoption is because it gives them a further avenue to hedge positions they have in the spot market. It gives them an additional tool at their disposal for portfolio optimization. Then, of course, we have to consider the free publicity this is likely to bring Ethereum amongst this CeFi investor class. The moment that this launches, you can bet your bottom ETH that there will be a slew of coverage for it across all the mainstream media. The CME will no doubt want to drum up interest from all potential clients as to this amazing new listed instrument that they have on offer. You only need look at what happened to the price of Bitcoin post the BTC CME futures going live in late 2017. I also happen to think that this may only be the first salvo from the CME on the Ethereum front. Let's not forget that last year they launched Bitcoin options on the exchange for the first time. We've seen a great deal of open interest and volume since the launch of these Bitcoin options. So, if the excitement for the ETH futures followed suit, I would not be surprised if we see ETH options on the CME by the end of the year. All of these provide not only additional tools for these large investors, but further news headlines of Ethereum's adoption by the men in suits. Now, I've been talking a lot about these traditional CeFi money men buying ETH. And this is great and all, but this is crypto, and over here, things are decentralized. There's no doubt about it. 2020 was the year of decentralized finance, or DeFi. We started with total value locked, TVL, of just below $500 million and are currently sitting at just above $20 billion. So yeah, just try and wrap your head around that. We have a 40x in the TVL. And this is not some obscure altcoin, it's capital locked up in DeFi smart contracts. So yeah, those are some pretty crazy numbers. However, you want to know the real crazy thing? Over 95% of that DeFi exists on the Ethereum blockchain. That means that all that crypto that's been locked over there is Ether. $20 billion in ETH has been taken off the market and locked into these protocols. This is ETH that is no longer on the market and hence means less ETH available to sell. As we all know, less supply and more demand is the Economics 101 formula for a price increase. You should also note that this TVL is a lot more sticky than the funds that were sent to ICOs back in 2017. Firstly, it's not up to ICO project teams as to whether that locked ETH is to hit the market. It's completely up to the users that send their funds there. And these users are not the same as those that threw their money into a shitcoin ICO back in 2017. They're generally more experienced and know exactly why they are allocating capital. It's mostly yield optimization strategies and supplying liquidity, but it feeds on the ecosystem positively. So what you have is a situation where you have much less ETH on the market due to supply being locked in DeFi protocols. Now, I have another piece of interesting on-chain data to share with you folks that can help feed this narrative of reduced supply. This is the total amount of ETH in exchange wallets. As you can see, there has been a sustained decrease in the amount of Ether held at the exchanges. Users are removing the ETH that they hold in exchange wallets and are self-custodying it. This could either mean that the ETH is going to be hodled for investment purposes, allocated to a DeFi protocol, or sent to the Beacon Chain contract. More on that in a bit. So, ETH is becoming a much scarcer asset on the open market, that's for sure. However, that is just the supply side of the equation. We can't forget that Ether is also a utility token, and in order to use the Ethereum blockchain, you have to pay fees in gas. This all means more demand. So, how is this demand looking? Well, we only need to take a look at the total amount of transactions on the Ethereum blockchain over the past year. As you can see, the number of transactions has been steadily increasing. We've recently seen it break past 1 million transactions per day. In the first few days of January, we've seen a massive increase in the amount of fees being paid. These gas fees are, of course, paid in ETH, and hence this increased demand to settle transactions leads to increased demand for ETH itself. Now, what's driving all this transactional demand? Well, it's a number of use cases, but I think a lot of it has to do with stablecoins. Yeah, Ethereum has become the dominant settlement layer for most stablecoin transactions. We're talking PAX, USDC, SUSD, and last but not least, Tether's USDT. Over the past few months, we've not only seen a massive increase in the total amount of stablecoin issued on the Ethereum network, but also the total transfer volume. Billions of dollars of transaction volume are being settled on the Ethereum network. This, of course, all means demand to use the network and, with it, demand for gas. However, I happen to think that this is only the start. We're likely to see an avalanche of stablecoin issuance and demand on the Ethereum network in the coming months. What makes me say that? Well, two things. Firstly, you have the news that Visa has partnered with the Circle Consortium to connect Visa's global payments network to USDC. Just to give you an idea of the scale here, Visa's payment network has over 60 million merchants, and Visa literally processes trillions of dollars every year. What this means is that if only a small fraction of these merchants start accepting payments in USDC, we are talking about billions of transaction volume and stablecoin demand. And given that ETH is the largest USDC settlement layer currently, that all means massive amounts of utility demand right there. However, there is something else that is perhaps more groundbreaking than the Visa partnership, one that is likely to embed stablecoins deep in the heart of the US financial system. I am, of course, talking about that recent stablecoin announcement by the Office of the Comptroller of the Currency, or OCC. Basically, the OCC has stated that federally chartered banks can facilitate stablecoin payments. The OCC has also said that they can run their own independent nodes on the stablecoin network. So, what all this means is that banks can use public blockchains to validate, store, record, and settle payment transactions as long as they're compliant with existing laws. To get an idea of the significance of this for crypto, you only need to take a look at this tweet thread from Jeremy Allaire, the CEO of Circle Financial. Interbank transfers are the lifeblood of commerce in the US, and by being able to settle these transactions on-chain, banks can do them quicker and more effectively than they can with traditional transfer methods. The value of interbank transfers in the US is in the trillions, and as we know, banks are always trying to save themselves fees and stiff us in the process. I would not be surprised if a reasonable number of early adopters will decide to settle transactions like this. And if they do, what network do you think they're likely to use? Yep, that's it. Massive utility demand for a scarce asset with a limited supply that's simultaneously being added to an institutional investor portfolio at a rapid clip. Now, I bet you think that's it. Well, my friends, there is one really fundamental factor which I've yet to mention. The first phase of Ethereum 2.0 officially launched on December the 1st of last year. For those that don't know, this was when the Beacon chain officially went live with the Ethereum 2.0 staking contract securing enough funds to launch. Now, exactly how monumental ETH 2.0 will be for the network cannot be overstated. There are so many updates that I can't go over them here. However, feel free to watch my Ethereum 2.0 video from last year if you want the full lowdown on it. That's linked to in the top right now. The most immediate impact of Ethereum 2.0 right now is the fact that a massive amount of Ether is being locked into the ETH 2.0 staking contract. Here you can see the cumulative ETH that has been sent since November of last year. We're currently sitting at over 2 million ETH locked into that staking contract. The benefit for those that have sent ETH to the staking contract, including yours truly, is that there are staking rewards. However, and here's the important point, ETH sent to the deposit address cannot be withdrawn currently. So this basically means that ETH locked in that deposit contract is off the market for some time. Any more ETH that is sent there is taken out of circulation immediately. Now, I'm sure you know where I'm going with this. Less circulating supply on the market means an asset that was already scarce has become even scarcer. So, let's add all of this to our ETH hopium potion. Increasing institutional demand, increasing whale demand, reducing exchange balances, increasing ETH being locked in DeFi, increasing stablecoin demand, increasing ETH locked in the Beacon chain. Now, how does that potion smell to you? You're right, it needs one more ingredient, and that would be EIP 1559. This is a juicy Ethereum improvement proposal that will change the way that the market for Ethereum transactions works. Basically, it would alter Ethereum's current bid-based transaction market for a set fee, the base fee. This base fee would then be burned on the network, which of course means that ETH will be taken out of supply. What this could mean is that the fee burn may be enough to offset any of the effects of additional ETH protocol inflation. So, in other words, in the long run, you have zero new ETH hitting the supply and only the current supply on the market. This could neuter the argument of many that point to ETH having no supply cap as a reason why it can't have long-term value. And, according to an Ethereum core developer, it's going to be implemented. Yes, some miners may not be happy, but it has broad community support. Moreover, the miners' displeasure at the upgrade could be rendered moot when Ethereum progresses to proof of stake with the 2.0 upgrades. So yes, add fee burns to that potion and it's now ready for consumption. Take a sip. I hope you're ready for a wild ride. That's it for most of this video, folks. Just a few thoughts to close off with. The Ethereum network is really at a pivotal juncture in its storied history. It's going through a monumental upgrade at the same time as demand is through the roof and supply is being constricted. These are all price positive, which is why prices are looking positive. However, prices are still below levels we saw back in 2017, and as we've established, it's completely different this time around. We're in a new frenzy driven by institutional demand from deep-pocketed whales and funds. It's being used to shape a new financial paradigm, the consequences of which are destined to be felt for generations. Are there risks? Of course, there always are. We all know that ETH 2.0 could be delayed. We know that the risk, no matter how minute, of a critical failure in ETH 2.0 is possible. Perhaps those DeFi degens decide to withdraw all their ETH from DeFi protocols and throw it on the market. But these risks are very small, in my opinion. Risks which I am willing to take. This is why ETH makes up such a high proportion of my personal portfolio. And I am perfectly happy about that. Now, am I forgetting something? Ah yes, that price prediction I promised. We will definitely be breaking through ETH's previous all-time high of $1,500 within the next 3 to 4 months. The momentum is there. And then, assuming that we do see the market pivot into alts, a $2,000 price is easily doable by the middle of the year. Of course, that's my opinion as a non-financial advisor. You good people have to come to your own conclusions. That's it for today, my friends. Enough hopium potion from this crypto shaman. Do let me know, though, what say you fine people? Yay or nay? Do you have any questions for me? Fire them into the comments. Also, while you're down there, you just have to check out my dedicated socials page. This has links to all the places you can follow me. Places where I share content you won't see on the tube. Content you definitely don't want to miss. Yep, all below. If you enjoyed this video, then share the love. Show that like button you care, and don't leave the subscribe hanging either. That bell also looks a bit lonely, so you may as well pay it a visit too. Till next time, chaps and chapesses, auf Wiedersehen. I bet you thought that was all. Well, I always leave the best for last. And because you made it to the end of that video, I have something to share. This is my weekly email newsletter. It's my way of succinctly crystallizing my views on the crypto markets for the week ahead. And nowadays, I also share unique insights as well as juicy coin tips. So, keen to be a part? Well, you better check out the description where I've linked to a sign-up form. All you need to do is enter your email address and hit submit. Be sure to confirm your email, and that's it. You are now locked, loaded, and ready to receive my next email. Oh, and it's weekly. I hate spam, and you won't be getting any from me.